The only thing that's going to break this pricing scheme, this fractional reserve pricing scheme, is people standing up and saying, I want delivery. And that's actually what happened on March 23rd and 24th. And there are articles been written about HSBC losing $200 million in one day because there was metal demanded and the system, the banks weren't able to provide it.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And tonight it is part 2 of the recent interview I did with Craig Hemke, where he digs into how he sees this all playing out, as well as some other fascinating things that are happening in the silver market. So I hope you're getting ready, and here it comes.
So what is really the price? And that's one of the more positive developments, like I said, to come out of this, is getting people to realize, well, wait a second, this futures price, that's not the price I pay.
Right.
And get you to realize that there's really no connection between physical supply and demand and this derivative derived price. There's really none. What you're seeing in the derivative is the supply and demand of the derivative that sets the price. And anyway, the more people that realize that, the better, and moves us further along that path to getting some kind of change into how price is determined.
Yeah, and certainly you've been one of the leaders in helping to share that awareness, because I've wondered, at some point, rather than, now we're saying the premiums are X over spot, but I don't know, maybe the price of silver is what it costs to actually buy it. And, the Comex price is kind of like the Federal Reserve's expert economic analysis. It's just irrelevant. They can say whatever they want if they con people into believing it.
Right.
But here's a fun one for you. We know how Americans like the buy high, sell low, invest on momentum ideology. So if gold's already 1750-ish, the Fed just said they're never going to raise interest rates. God knows how much money they're really printing. What happens to silver when gold's going through 1900 and 2000, and CNBC's talking about it? It feels to me, obviously, I'm in the running for world's biggest silver bug over here, so maybe I'm biased, but and then when people look, it's not only a third of the 2011 high, but a third of the 1980 high, while gold's doubled that. Is there some way that we don't see like the lemmings flocking at some point into silver?
I probably not. You think just even a substitution effect eventually takes hold, right? Because I don't see a scenario. These people like Harry Dent or whomever, that gold's going to 700, which is something he said every year in the beginning of the year for like the last 7 years. You're always going to have those types out there that see some kind of weird, crazy, massive deflation. Absent those people being right about deflation, what I see is just the central banks constantly devaluing their currency by printing more and more and more of it. Eventually, even getting into a scenario where, who was it I was talking to back before I went on vacation? I think it was Luke Groman, who said what he thinks is happening is the central banks that are around the world are calling in as much debt as they can, corporate and sovereign, and they're going to own it all themselves before then they just kind of nationalize it all, write it all off, and mark up gold to give them the ability to do it. Okay, that could be it too. Any one of a number of things, a collapse of this pricing scheme, and then all of these fundamental factors that are in gold's favor. I just don't see a long-term trend where it's suddenly going to plummet. So you're right about the momentum. Once we're above 1800, 1900 will probably come pretty quick. And then, that'll be a whole double top. People trying to say there's going to be a double top and all this stuff. And then eventually, once it gets through 1900, then then we get into almost kind of a mania phase for a while too. So then back to answer your question, how is there not like a substitution effect, right? Can't buy steak, so I buy hamburger because the cost of steak's gotten so high. And so people go, well, gosh, Gold's $1,900, but silver's only 19. I can buy 100 ounces of that versus 1 ounce of gold,
I
and
mean,
so eventually then you can just rally.
the rate at which people are buying silver relative to gold, I mean, it's fine for us
Right.
to sit here and say what we think the ratio should be, but
But
when people are actually buying it at the current,
that doesn't matter. As we just talked about. I mean, nothing about physical supply and demand makes much difference. I mean, look, how many ounces did you say went to the SLV, right? Mexico and Peru were both offline for 2 months. I mean, Mexico does 15 million ounces a month and Peru does 12. So that cost us what, 50 million ounces? None of that seems to matter. So it's still at this point, physical demand of the metal doesn't really, obviously doesn't really have a lot of impact on price. But when the demand for silver in all its forms, when you actually get people wanting futures contracts, taking delivery to the point where the stress becomes in that system and it kind of feeds on itself and you get a lot of momentum and short squeezes and all this stuff like we had in 2011, it can go really fast. But until that kind of thing happens, it may just continue just to slowly move along with gold at this like 100-to-1 ratio.
yeah, in fact, that's pretty much what I expect, where, we'll see when it happens, but I don't know, silver and gold, maybe not gold, we'll see, but I expect silver to basically be like watching paint dry until one day. I see it as a very binary thing where, you know, we'll see, and that will time with our last question, a comment I had for McGuire. The one thought about what you said, I get why Harry Dent and some of those guys are saying it, because they look back to 2008, well, when all heck was breaking loose, gold 1,000 to 700, silver 21 to 9. Everybody says that's panic selling, although with due respect, I would dispute that, because we heard Bart Chilton, the thing that most people didn't pick up the first time hearing it, is he says after JP Morgan took the bear position, it was over the allowed limit, he gave them a waiver to reduce it. They made it bigger. This is exactly when the metal was falling while dealers were they couldn't, Miles Franklin thought they were about to shut down because they couldn't get product. So
Right.
I don't know if that's panic selling, but Craig, the last one to wrap up.
Hold on, Chris, hold on.
Yep.
Just some color back to that in 2011, because then what happened is you did get a commercial short squeeze.
Mm-hmm.
I mean, the final 25% of that, it's the price starts going like this, right? And in the end, in April of 2011, the speculators, the hedge funds, were all reducing their long position. What was happening was that massive position that JP Morgan had built up was getting squeezed, and they didn't have a Comex vault back then. They didn't have any physical metal. They just were manipulating the market and they got squeezed. They got caught with their pants down. And so you got the 5 margin hikes in 9 days after the Sunday smash. All of a sudden, JP Morgan gets rubber stamped for a Comex vault. They go from having no ounces to 170 million ounces now, so that now if it ever happens again, they can deliver the actual physical metal. So that's how a short squeeze can happen. And that's what did happen. Just kind of a lot of sudden rush of demand for the futures contract is what really finally drove that price. I'm sure some of the physical had a little something to do with it. People wanting, looking for metal anywhere they could get it, take delivery of it, and hedging and that kind of stuff. But that big move then was more like what you talked about earlier, which is, a sudden rush of momentum and people wanting to get into it because of inflation concerns and QE2 and all this kind of stuff. But man, when it really took off, it was a short squeeze of the banks. And that would be a fun thing to see happen again.
Yeah. And
Anyway, I interrupted you. I apologize. You had your...
No, I mean, I appreciate what you're saying there. It seems to me that it's kind of like when you do certain things, you add enough leverage to anything. I think it's inevitable. The last one to wrap up. Here's a quote from our friend Andrew McGuire. He said I could share, where on June 1st, Swiss refiners are now putting silver orders on hold to meet very large gold demand. We were anticipating weeks into July. Now our orders are pushed out months. For size, there are no offers to sell. So in the end, there's signs that we're getting there. We don't know how much is Corona related, but are we headed towards an inevitable break point where someone shows up, whether it's 1 month the deliveries are too big, but someone shows up for their metals, and at that point, eventually, whether it's a force majeure or some sort of failure, and if you care to put a price target on the end of the year for silver, you can put it in probabilities saying, well, 50% chance it'll be sitting right there, or X% chance we do see Comex failure. So any thoughts on that as for the last one today?
Well, we're headed toward that point. I mean, I've written about this now for 10 years. I mean, the only thing that's going to break this pricing scheme, this fractional reserve pricing scheme, is people standing up and saying, I want delivery. And that's actually what happened on March 23rd and 24th. And their article has been written about HSBC losing $200 million in one day because there was metal demanded and the system, the banks weren't able to provide it on an overnight basis right then and there. And the system got exposed. And that's why the CME rush, like by the next day, the 24th or the 25th, had this scheme cooked up for a whole brand new contract that could deliver fractional ownership of 400-ounce London bars, because the Comex contract's 100 ounces. And so they were on the verge of that type of recognition, if you will. Wait a second. Whoa, what is going on here? I want my metal. Okay. So they've kind of band-aided it together, and you see these stories now about airplanes flying all over the place, trying to, and somebody actually that has no understanding of the global gold market wrote something about how there was a glut of gold because they'd flown. I mean, what do they have show now? 30 million ounces or something in the Comex vaults. I mean, it's just outrageous. But anyway, it's coming. Okay. There are far more synthetic obligations, promissory notes, leases, how much gold is actually in the GLD, what you name it, far more of that than there is the real thing. Okay. And so when the music stops and everybody's looking for a chair and wanting to take delivery of metal that they were told they had, but no, they signed paperwork and said, we'll get it to you in 90 days. When all that happened, okay, then that finally forces breaks the system, forces the hands of the banks. So when does that happen, man? Yeah, we're getting close, obviously, and I think we're getting continually closer, because I don't think that where we are is not going away. This COVID thing, I may feel a little bit better about walking around outside without a mask or something like that, but the damage is just so extraordinary. What are we going to print in the U.S. this quarter, Chris? Like negative 53% GDP. Okay, so you can talk about V-shaped recovery and 10% growth in the fourth quarter or something, but how many quarters in a row at 10% you got to do just to get back up to even after you drop 50%? Okay, so this damage and what it's done to tax receipts and states and pension funds, and I mean, there is no going back. So all of this monetization, all this cash is going to have to be created to try to punch, fill all these holes now that are in the dam. I just don't see where demand is going to get any less. And then that eventually pushes these banks to the brink. But again, who knows? Could it be August? Maybe. I don't know. September. Maybe. I don't know. What I do know, though, is that the demand for the metal in all its forms is going to continue. I've been writing about this, obviously, for 10 years, but beginning last year, and if you think back, I mean, gold hadn't even been about 1350 for 6 years. But the Fed lying through their teeth, talking about interest rates going back normal, and it got to 3.25% in November of 18 and crashed the stock market. Yep. The only thing that saved it the day after Christmas was a Christmas Eve meeting of the plunge protection team, which I'm not making this up. You can just Google that. Yep. And so you knew that rates weren't going any higher and that the Fed was going to have to reverse course in 19. And I said, well, okay, that gold's now going to break out. And it did. In fact, hit exactly what we wanted to for a target first in August, and then finished the year right at 1520, which is where the upper band of the target that we had. So now for this year, I thought, well, this is only going to continue. I couldn't see COVID coming, but I thought we'd get to somewhere around 1750 or 1800 in gold, 21 or 22 in silver. I'm sticking with that. You know, we're banging away in this range. And I think if we can get through 1780, which we will, we'll probably go to 1880 sometime late this summer or fall. So I'd say a little higher in gold than what I thought.
Yeah.
But silver, it just wouldn't surprise me if we can just get to 21 or 2, like I wrote back in January. Well, we began the year at about 18. Okay, so that would still be 20 some odd percent, 30%. I'm trying to do the math real quick. And then once you got to take it in steps, kind of like gold. Gold had to get above 1550, and then it could, target 1650 and beyond. Silver's still got to get a 2 in front of its price.
Yep.
And then if it can get above 22, then it can set its sight on 26, because when gold was trying to get above 1550, because that was the old price, that was the floor in 2013. Well, the old floor for silver was 26. So it's got a lot of catching up to do. But it's going to do it in these stages, which in the end is good for everybody, because it means that you got plenty of time,
Yep.
If you can get your hands on some to prepare for all of this, which is just almost, I just can't imagine a scenario where this isn't coming.
Yeah. And the last thing you mentioned there, I love, where I know there's people like me and others who are excited to see the price finally rise and get frustrated when it's down. Although if you can change that mentality a little bit and say, hey, well, I can keep buying an asset at a reduced price, I think that's perhaps even more important than any analysis of the markets. We know the way it's set up might be unfortunate. Although what is quite glorious is that, Craig, you were kind enough to create TF Metals. So if anybody really wants to know as soon as possible what's going on, what is going to happen, perhaps before I let you run, you could just talk about the site for a second.
Well, it is, a labor of love, if you will. Extraordinarily fortunate to have stumbled into it, because it was not my intention 10 years ago to turn myself into some kind of, guru or whatever the hell people want to call me. But it is what it is. And I'm extraordinarily blessed to have it. I do my analysis every day, twice a day, a report in the morning, like you're seeing here, where it says Red Monday. That's what I wrote this morning. And then a podcast every afternoon, kind of summarizing, what you missed through the day. It's my job to sit here and watch this stuff all day, so that, all my members of the site can go do whatever else they want to do. And then they can just check in and find out what they missed. Community, though, is probably what makes it unique, because there's all these subscribers from around the world, all political bents and all that stuff. But we realize we're all in the same boat, man. We all, we can all argue about politics and stuff, but at the end of the day, it's the monetary system and the global economy and all that stuff is that's going to take precedent over everything else. And so we realize we're all in the same boat in that regard. The site is $12 a month. So it's not like, servers cost money, health insurance costs money. So, there's a cost to joining the site, but and I'm just going to put this out there now, Chris, because since you and I've been talking about it, but Chris and I thought this would be a fun thing to do. I can run a coupon code on my site that if you go to TF Metals Report, click to subscribe, pick the monthly subscription option, and then you enter the coupon code Marcus. You like that one?
How about we make it Arcadia?
Arcadia. Well, is that easier to spell than Marcus? It's up to you.
Well, or we could make it. I'll have it. We'll figure out, and we'll put it in the description link below. But that way, anyone who signs up for the site.
I know. Hold on. I got it. SLV. We'll make it SLV.
Okay.
All right. So you go to TF Metals Report. You go to the subscription page. You sign up for a monthly subscription, which, again, you can cancel at any time. It's not like you're signing up for a monthly subscription and now you're doomed, like some of the stuff I see on my credit card that I never cancel. Like, am I still paying for that? You can cancel anytime. But for the first month, at least, it'll only be $6. So 20 cents a day. And then if you don't cancel, it goes up to 12 the next month. At checkout, there'll be a little box that says enter your coupon code. We'll make it SLV. Okay? That's easy to remember. Then here's what we'll do. Anybody that does this, I'll send your email address to Chris, and then Chris will get in touch with you. And what are you going to send him, Chris?
They will get a free audio copy of The Big Silver Short, a book that I feel blessed to have been a part of. Your
So do
interview
I.
in there was incredible. I think it, again, I'm a little biased here, but the fact that you heard from 15 different people share in their own perspective, like the Hunt brothers, and Warren Buffett, it wasn't just one person talking about how Warren Buffett got forced out and it, for people who want to be prepared for what's coming. And I think I'm biased again, but I tried to lay it out as clearly as possible. And folks who sign up to TF Metals will get a copy of that complimentary of
How's
Arcadia.
that? What a great deal. But wait, there's more. No, I'm kidding.
Oh. You're going to give away free silver too.
Yeah, right. And a Ginsu knife. Anyway, but I love that idea that you had to do this, and I think it's great. So again, sign up to TFMR, use the coupon code SLV, gets 50% off your first month. I'll send your email address to Chris, and he'll send you a link to the
Yeah.
book.
Well, it's been a pleasure getting to know you, and I'm excited for the things going on. I love the picture. This little girl here looks like she just traded some dollars for silver. She's like, Jerome Powell, stick it. But it will be fun to follow along. And, thanks again just for all the information you lay out, and the description, or the link is in the description below for tfmetals.com. Craig, thanks again for being here. Great call today. We'll look forward to catching up again. And folks, if anybody is wondering what's actually happening on the physical level, well, stay tuned, because the recording of last week's physical silver and gold market update is coming your way now.